We have our investment panel, so looking at all of the global macro factors impacting the sector's investment outlook. So joining me here on stage, we have John Forwood, Chief Investment Officer at Lowell Resources Funds Management. We have James Morrison, Portfolio Manager at Regal Resources Royalties Fund at Regal Funds Management, and John Dorian, Investment Manager at Orion Resources Partners. So maybe to kick things off, if you want to just do a quick intro and let the audience know a quick bio about yourselves.
Shall I go first?
Sure.
Amy? John Forwood from Lowell Resources Fund. The fund is a small listed investment fund that just focused on the junior sector of the resources space. So we're really looking at things that are sort of sub $200 million market cap as our entry points. And we have a bit of a exploration bent. My background years ago is as a exploration geologist. So we're looking for things with a nice little exploration kicker. And everything across the spectrum from precious metals right through to oil and gas and energy.
Yes, hello. I'm James Morrison, and I'm one of the managers of the Regal Resources Royalties Fund. We're also a relatively small fund. Last year we generated about close to $40 million in royalty receipts. So we've got strong income, where our mandate is to invest in energy, metals and renewable royalties. We're an open-ended fund, and we're a trust actually, so we pay out all our income to our investors, which they like. My background, I was in commodity trading and sales, and had a short time in private equity as well.
Hi, John Dorian, Investment Manager at Orion Resource Partners. We're a private equity fund, US headquartered, with about $8.5 billion under management, and we're focused on late-stage development finance, acquisition finance to the mining and materials sectors. So we've got a pretty broad mandate in terms of sector and product.
All right, great. So we're going to keep this pretty informal. And so if at any point in time during the session you have any questions that you want to ask the panelists, then just put your hand up and we'll get a microphone over to you. So I'm sure they'll be happy to answer your questions over mine. But to kick things off, let's talk a little bit about the biggest risks and challenges for the mining industry today. So maybe looking at the impact of the current geopolitical economic landscape, impacts of inflation, et cetera. So, what are you finding to be the biggest kind of market drivers right now? John, do you want to? You're closest to me.
Yeah, look, it's a really interesting question. I think, from the outside, you might say, recycling would be a big risk for the mining industry because, eventually, hopefully, that might replace a big part of the new metal required. But that's actually not the case. The demand for the increasing demand for metals means that recycling is always going to be playing catch up, at least in the mid to longer term. So I think, Amy, you mentioned inflation, and I think that is really a big challenge right at the moment for a number of reasons. The obvious one is the cost escalation of projects. So, we're seeing capital cost blowouts, and we're also seeing OPEX. While the metal prices are still relatively good in many cases, OPEX has been escalating and due to inflation, and so margins haven't been nearly as good as you might have hoped. But on the sort of in the broader sense, particularly in the space where we play in the junior sort of exploration pre-development phase. The result of inflation is obviously higher interest rates, and higher interest rates have really impacted the availability of finance for that part of the sector. And that's because you can put your money in the bank and earn 4 or 5%, or in some cases much more if you're prepared to take a bit more risk. Whereas you invest in a speculative junior gold explorer, for example, and you get no return, and in fact sometimes you're seeing these things going backwards even when the results have been good. So yeah, look, I think inflation is a big one, a really big challenge at the moment, and the outlook for that who knows? But certainly, with oil prices remaining high, that's a significant factor in playing into ongoing inflation. So maybe we haven't seen the end of the high interest rates yet.
Yeah, in terms of risk factors, I think John's covered those factors very well. Specifically for us, it gets to things like, I'll get a consultant in to look at a project, and I'll say there are these things that need to be done to get this project back to where it should be, and let's say it's in development. And they say the issue is all those things are doable, but can they access the people to execute those tasks? And so when you come down from a scarcity of labour to a scarcity of the labour you require to execute, and I think this has been telling for a number of projects and remains a really significant risk factor for us in our assessment.
Yeah, I think I build on that, James. I think the ability for companies to execute as a whole on their business plans, I don't think it's just the availability of labour. I think as an industry, there isn't a fantastic track record of creating shareholder value in many instances, particularly when it comes to development. And I think the industry could be better at that. It's not a fantastic environment in terms of inflation, costs, availability of labour. But when it comes to actually executing on a plan, incentivization of management, all these factors, I think could be improved upon. I think when it comes to the biggest macro factor we're focused on, I think permitting and regulatory regime still remains a huge risk to so many of the projects, particularly those perhaps in developing jurisdictions and even the more advanced or more developed jurisdictions. Ability for bureaucrats to meet mandated timeframes to receive permits. I think there's a bit of a disconnect between the global imperative to provide the infrastructure to the infrastructure, as we kind of characterize the raw materials, but ensuring the policy settings and the permitting timeframes, regulatory timeframes meet that demand. So I do think that's something that is a persistent risk.
And John, I think those two things might be actually linked. The departments are struggling to get people to tick the boxes, and in some cases that those people are getting poached by the private sector. So it's almost a catch-22 situation.
I mean, one of the biggest impacts of all of these new regulations is this kind of the resource nationalism and kind of deglobalization sentiment that we're seeing across the sector. So, maybe to tie that in, how do you find, regulations such as the IRA that are really kind of forcing the change of supply chains and everything impacting the industry as well? Anyone?
Shall I comment on that? I think it's really interesting to see the effect, particularly of the US, not just the IRA, but Department of Energy, other pools of money coming out of the US, and it does seem to be very much anything but China, to be frank. You are seeing that money going quite far afield. Like last week, there was a UK company with a graphite project in Uganda that announced it was going to receive some money from the Department of Energy in the US, which is quite surprising. But yeah, look, there's money available for those sorts of projects. If the supply chain can be avoid China, but you would think that this would drive companies back to North America, Australia, etc. But it's interesting to see the big guys. I'm talking about Rio Tinto and BHP actually going to more far-flung places. So Rio obviously going to invest a huge amount of money in Guinea, and have just started doing that on the Samandu iron project. They're also obviously very committed to Mongolia with the Oyu Tolgoi project. BHP have last year put some money into Tanzania, going back into the Kabanga nickel project. So it's not necessarily the case that these funds are pulling investment back to very, very safe jurisdictions.
You mentioned the Inflation Reduction Act, I think, yeah. And obviously, I think everyone wants to see the world decarbonise. Fabulous article in the Telegraph, the UK Telegraph, on Friday by a guy called Henry Kelly. So he's a emeritus professor from Cambridge University and a member of the Royal Society and an engineering guru. And he sort of outlined the task ahead as we want to see net zero, which is, I think, one of the goals of the Inflation Reduction Act and supporting the development of critical minerals and the like. And basically to say that when you look at what has to be done just in that country, you're talking about spending in the order of $30+ trillion on decarbonisation initiatives if you're serious about hitting net zero by 2050. So it just makes me so incredibly bullish for commodities, particularly the energy-heavy ones, steel, so therefore iron ore and others. And I think that the lasting impact of these initiatives will be, I don't know if they'll reduce inflation, to be honest with you. I actually think you will see just sustained strong commodity demand into the future, and it'll ebb and flow as governments pour money into things. But the $1 trillion initiative is just a drop in the bucket, really. If you believe the assessments, it'll take more than $30 trillion to decarbonise, and if there's a bit of, if you try to build in a bit for intermittency of renewables and battery storage, it quickly becomes 3 times that number. And so you're just talking about massive numbers of spend required, and he estimates that the construction, the number of people required in engineers and construction will be equivalent to the existing construction sector in the United States. So talking about just gargantuan numbers. So probably say it's not going to happen, but the effort of getting there, in my view, or getting partially there, will be so incredibly bullish for commodities.
Yeah, I think the only thing I'd add to that, perhaps at the more micro level, there are a huge number of options that companies have available to them as part of the IRA. I think we've seen that with some Aussie companies, Syrah, which has tapped some DOE funding. So I think there's a huge suite of available products and incentives that weren't available to junior companies, and providing, as I sort of said before, that can be tied into the policy settings, sort of enabling these projects to go forward. It's pretty exciting.
Yeah, absolutely. I mean, the final question on the risk to the industry is really kind of just the ESG pressure, social license to operate, and the energy transition as well. So really, this focus on the environment, how much is that really impacting where investment might be going, and the growth of the industry? Maybe should we start at the other end?
Sure, happy to start. Look, ESG is core, I think, to certainly to Orion's business. It has been for as long as we've been a business. I don't think you can be in the extractives or materials or mining industry and not take ESG into account. In fact, I'd say it's probably more kind of native to the mining and materials industry than perhaps it is to other industries. So it's completely core to our business. I think it's core to our investors. It's core to the companies that we back. I think there are nuances in terms of how which parts of a framework you take into, or which frameworks you follow. But it is just core, and can't be, has to be considered in every investment decision you make. I think otherwise the risk is that you cannot avail yourselves of capital. So whether it's banks requiring equated principles as standard in terms of their lending requirements, whether it's your investors requiring action plans or analyses for projects. It has to be considered.
I think the reputational damage which can accrue to a company for not acting appropriately only has to be seen with how Rio Tinto handled the whole Juukan Gorge thing. The reputational damage that they suffered with the young generation, particularly in this country, particularly my own family, my own children, was just, I didn't need to be reminded about bad behaviour in the mining company by mining companies again. We're all very aware of it. It's key to what we do, and but as investors, we're very dependent upon the people in whom we trust that they will act with, I guess, full understanding for the impacts of bad decisions that they might take. And the way they handle themselves when they do make a bad decision, I think, is so telling.
I think just sort of putting another perspective on it, those interesting comments by BHP's, I think he's the Chief Development Officer, Johan van Jaarsveld, last week or the week before about nickel. And he got a question about, the lateritic nickel production in Indonesia, which is absolutely skyrocketed. Now, go back 2 or 3 years, there was a forecast major nickel deficit this year and next year. I think now, there's a surplus this year, and there's going to be forecast to be, I think, a 7% surplus in nickel next year. And so the comment from BHP was, investors aren't paying for green nickel yet. And greener nickel, if you like, which is more the sulfide ore sourced nickel versus the lateritic nickel, which is at least perceived to be dirtier out of Indonesia. And Indonesia, is forecast to be, well, it is the biggest nickel producer in the world now. So you've got that happening, and you've got investors saying, well, just give me nickel. And it goes back probably to your comments earlier, James, that the demand for commodities is such that, in many respects, at the moment at least, off-takers are turning a bit of a blind eye to the at least the E of the ESG as to where this metal comes from. And there's another interesting snippet last week. There's a new battery plant being built in Kansas, I think, in the US. Which requires so much power that the coal-fired power plant that was scheduled to be shut down had to be kept going to make the new green batteries. So I think we are moving towards ESG credentials in terms of where the metal comes from, and certainly in Europe we're seeing this. I think it's called CBAM, cross-border adjustment mechanism, for I think 6 or 7 metals now, which will there'll be basically a tariff put on metals that aren't produced with the right carbon credentials and carbon passport. But in other parts of the world, China obviously being the biggest user of metals globally, that hasn't happened yet.
I think we'll get more into this in the batteries panel later on this morning, but how do you think we close that divide between the need for metals and the need for green metals as well?
I think it's going to be extremely, extremely difficult at the moment. Ideally, you'd love to have, the US would love to have all their metal produced, in Canada or Australia or the US, and, be very green. But, as James said, the demand is just, so much larger than the capacity to produce that out of, friendly jurisdictions which have got high standards. I think it's going to be, there's going to be blind eyes turned for some time yet.
So how are we going to close the gap between... Okay, well, I think prices do a lot, right? So if we see higher prices being paid, then projects can come on. But the high prices are going to be a function of the underlying demand. And if, for example, I read suggested last week, demand for copper not quite as strong as what was anticipated, and with the sort of the expectation of perhaps the aspirational goals for 2030 are getting pushed out a bit further, perhaps things take a bit longer. And I think we're all wondering, for some of the very large copper projects, for instance, what price that those projects will require to proceed. So right now, I think that investors are trying to measure exactly what is the demand and the likely increase in demand, which will be there to satisfy this demand for greening the economy, and what price levels will be required for projects to go ahead.
Yeah, I echo what James has said.
Okay.
High prices should solve it.
All right. Do we have any questions from the audience before we continue on? Yeah, sure. We'll just get a microphone over to you.
Just while we're waiting for the microphone, just to answer your question in a very small microcosm, James, I think this Chief Executive Freeport-McMoRan said last week their Baghdad copper project in Arizona, which is 16 billion pounds of copper contained at its 0.33% grade. She said we need $5 a pound copper to make that happen, and we're currently at what, 350, 360 or something like that, and we haven't seen $5 for a long time.
Thank you for your insights. As an individual and as a company, what is your investment framework when you're making a decision on taking a position in certain company? Do you look at the macro sector and from the management aspect, like what is it where you go through that process? What is your framework, like from individual? It'll be quite keen to hear what is the number one factor that is non-negotiable, like maybe 1 to 3 max. Thank you.
Value. As an investor, you've got to see value, and that that's a very trite answer, but and then there's so much under that. But I think if you can see a fantastic project that ticks every single box, and I'm talking from an equity investment perspective, the lending perspective will be quite different. But you can see a fantastic project that ticks every single box, but if you don't see significant upside, and for us, it's a very, very risky sector. And so if you're going to take those risks, you need to see the potential for really big returns. That's it, number one in a nutshell. But there are a huge number of other factors as well.
We're a little different in that we look at the projects. We're largely, our main activity is acquiring royalties over projects. There's no liquidity for us with the position. So once we're in, we essentially can't get out unless someone buys the royalty from us, which doesn't happen so often. So our diligence is all up front, and that will be detailed. And so if it gets through our initial, filters, let's call them that the project is at the right place for us. And so we don't look at exploration the way John does. I'm not good at assessing that. I'm looking at a project which is where we can make a decision about when it will commence. That's the first point. Second point is we've got no idea where commodity prices are going. Yes, I'm bullish. Yes, I believe in decarbonisation, but I could easily be wrong. What do they say? Prices might go up, then down, but not necessarily in that order. And so I have to look at what are long-term consensus prices and where the project sits relative to its peer group. Will the project survive the economic cycle? That's one of the things. We get through that, and then we're looking at the quality of the management. And then, what we do is we're looking to pay for the reserves, and then if there's a resource to reserve conversion in the future, we'll get our upside, our return, if you like, above what we were banking on. So we're looking to, the best royalties. We've got one fabulous royalty in our project, which is a which is essentially returned our entire investment in 4 years, and it's got more than 10 years to go, and the reason for that is we've had these fantastic reserve upgrades plus very strong production. That's the holy grail in my business, is looking for those projects, those world-class projects which can deliver you those sorts of underlying returns, and so it's a lot of work. We'll only do, to give you an idea, 3 or 4 deals a year. There's only 2 of us, so we have to really focus on the projects where we can see those factors we want to see. And I know that may sound like puts up impossible filters for everybody, but they're our criteria, and that's how we're able to raise money from investors.
Yeah, I mean, I think it's almost impossible to narrow down to one thing in terms of Orion's investment process. There's a number of factors. I think a number have been mentioned, but to call out management quality, ability to execute to a timetable, catalysts for growth or for value accretion. Has management done it before? Where does the project sit on the cost curve? What is the level of technical complexity? I mean, it has to be a summation of all these factors, and a personal view or a house view in terms of if you're at a fund as to whether that's a good investment decision.
So how do you see kind of the investment appetite for the sector right now? Is there a growing interest? Is it a product of prices or kind of those other macro factors that are going on?
I'll go first if you like. I think it's mixed, right? So when you've got a US bond rate at 4.6%, it gives investors a new benchmark for which to price things off. That's the risk-free rate. This is the highest rate in many, many years now. So I think it's affecting the way all assets are priced. That's the first point. Second point is that I think that there's plenty of evidence out there to say that the marginal borrower is now paying a much higher rate than they were paying only a few months ago. And certainly the days of zero interest rates, official interest rates, are well behind us. And so I think these factors, but the appetite which you're asking about, I think is influenced by those 2 points. Probably John's the best one to talk about fundraising, but my own experience recently is that investors are very demanding when they can just receive a significantly high interest rate, essentially a riskless rate of approaching 5% right now.
Yeah, I mean, similar to James, I think there is a bifurcation or in the market. There is a lot of appetite, certainly at the well-followed explorer end of the market. There's some fantastic exploration stories on the ASX and more broadly globally. They continue to attract capital for the right names and the right teams. At the sort of multi-asset producer end, there's a good following there amongst those larger companies. Everything in between is still very difficult. I guess that's part of Orion's opportunity and James's opportunity and others in the space to try and close those financing gaps for companies developing or acquiring assets in that sort of in between part of the spectrum. But I think it's still quite difficult in that space, and we've yet to see on the public market side, despite the significant appetite for materials, we've yet to kind of see the flow back in of generalist money, which I guess is would be welcomed by a lot of companies.
I think you can. There's probably 3 commodities at the moment that are attracting investor attention. Lithium's been a market darling for some time. Rare earths is probably a little bit trickier, but still attracting investment. And then uranium has had a really strong run, and a number of the uranium developers and explorers are attracting attention. But other than that, you go it's really interesting to see the contrast between lithium, like a new energy metal, if you like, and the dirty old oil and gas, whereas, oil price has been rising, and oil, at least in the junior sector, shares have been falling, whereas lithium prices have actually been falling quite dramatically, but equity prices in lithium have held strong, at least until this point, and there's been a lot of money thrown at the sector. So and I think the other thing you can see, the bifurcation that John mentioned, is between the bigger guys and the smaller guys. If you've got, one thing that I've noticed is, if you've got coming up to a significant capital hurdle, i.e. you're a one project company, you're a junior, and you've got to raise significant capital to get that project from feasibility into development and production, it can be extremely tough if you're not in the right metal. So, just talking earlier about a copper project and a lead project in Western Australia, which are basically shovel ready. They've got opportunities to take structured finance, if you like, but raising the 40% of equity for the project development is a multiple of their market cap, and it's just not available.
Do we have any other questions before we start to wrap things up for this session? Okay, so I thought we could look just at investors' roles within the energy transition, because it does seem to be kind of the overarching theme to the industry today. So, we talked about Indonesian nickel and kind of, whether or not investors are necessarily paying attention to, or where their metals are coming from. So what do you think, what would you say are the investors' roles moving forward?
Look, I'd have to describe our fund as more a follower than a leader. Well, obviously, we try and pick the trends, but we've had quite a swing in terms of our commodity exposure over the last 18 months to 2 years. So we were 60% exposed to precious metals, probably going back 2 and a bit years ago. And that's been cut in half, and that's partly from our decisions, and it's partly what's happened to our portfolio in terms of the change in valuations. And replacing that has really been exposure to the battery metal sector, and lithium being the biggest one among them, and that's been through performance in a number of our stocks that are exposed to those metals. So look, we do try and pick the trends. We'll try and be proactive, but the performance of our fund is perhaps driven by changes in commodity prices and investor demand.
So I start from the position that I think that the world has to decarbonise, but to do that we need more of everything, and we certainly will need more. We'll need more solar, we'll need more wind. That goes without saying. But I think we'll need significantly more nuclear. I mean, I expect that energy consumption will double by 2050, because of the growth in developing countries alone. And so I think that gas will play an incredibly important role in decarbonisation to move us away from less reliance on coal. Just got to remember that last year was the biggest year ever for coal consumption, the biggest year ever. The popular narrative would have you believe something else, but there's such incredible demand at the moment for energy, and I don't see that stopping. Our largest royalty is a royalty over a gas project in the Surat Basin operated by APLNG. It's been fantastic. It prices out against gas and oil prices because it's sold as export. And despite I think very strong anti-gas lobby, I believe that gas will be incredibly important both in this country and throughout the region. And so I think investors, I just saw the French signed a deal, it was a 27-year deal with Qatar for the sale of gas to them. And so I think that certainly we're seeing signals coming to the energy market which are very strong. Just seen the largest, Exxon do its largest deal, I think, in 20 years, acquiring the biggest player in the Permian in Texas. You know, those guys are the smartest guys in the room, there is no doubt. So I think the future, just to summarise again, I believe in decarbonisation. I think you're going to need more energy of all types to achieve, to lessen reliance on coal. But the investment signals coming to the market are quite clear.
Yeah, just to build on that, I think, from my perspective, from Orion's perspective, I think we'll, continue to stick to our knitting. But for other investors, I think, being clear-eyed about the energy transition, being clear-eyed about the requirements around decarbonisation, whether it's gas, whether it's uranium, and picking winners and backing companies in those sectors, but being, honest about what the transition will require. And that probably goes for governments as well. Having a sort of honest discussion with the voters about what it's going to require, and allowing the investment to follow.
All right, sounds good. And so to wrap things up, I know you said we can't really predict where pricing will go, whether it's going to go up or down or in what order, but thoughts for the year ahead?
Look, in a macro sense, I think, we are going to be in a higher interest rate environment for, well into next year. It looks like now. I think, back in the start of May, I think it was, when Jerome Powell said, I think we're closer to the end than the beginning of the interest rate hiking cycle. Gold price spiked to over $2,000 US an ounce, and equity prices really start to move up. But as May turned into June and everyone realised that wasn't going to be the case, then gold price fell away. Equity prices start to come back in the sort of junior and mid parts of the sector. So look, I think that's going to be the macro setting for well into next year. If you want to pick, my job is to try and pick the next lithium for our fund. Don't. I can't tell you what it's going to be, but there are some commodities which show similar traits or elements to what drove the excitement in lithium. And I think James, I think you talked about nuclear and uranium, and uranium prices had a very strong run over the last 18 months, and that could well continue. I think one niche metal which is interesting to us is graphite. Graphite is required for 50% of all EV batteries in the anode. It is a tricky commodity because there is a very high specification demand from off-takers. But the forecast demand for graphite as the EV build out happens could see the price of graphite be very strong. So I'm not making predictions, but there's a couple of commodities that we're interested in.
Well, when you've got one war going on in Europe right now, Russia's invasion of Ukraine, you've got Israel just declared war on Hamas. You've got proxy wars likely to break out all over the place as a result of that. You've got a bond rate at 4.6%, and you've got 7 big companies in the United States carrying all the earnings. It's a pretty interesting setup, and so I think the investment markets are as interesting as they've ever been. I think I have no idea how the high interest rates and high earnings, which will give up first. I suspect that finally earnings will crack. But the equity markets have a certain resemblance to October 1987, and I sincerely hope that doesn't play out, given how strong earnings are. So, on the assumption that the economy remains strong, interest rates remain high, I see tremendous demand down the track for iron ore, and for many and for all the base metals.
Yeah, I mean, Orion doesn't make price predictions, and I'm certainly not about to. But I do think the skew overall, in terms of a thematic, feels tending towards higher for longer. So as investors, we all really need to plan accordingly for what that could mean in terms of our downside projections and, you know, how companies can cope, what margins will be represented in those circumstances.
All right, sounds great. So any final questions for the panelists before we wrap it up? All right. Well, then, in that case, I want to thank our panelists for joining us this morning.